In December of 2024, a company you almost certainly have installed on your laptop right now did something that should sound, on paper, completely insane. It borrowed $2 billion. Not to build anything, not to launch a new product, not to acquire a competitor. It borrowed $2 billion specifically, so it could turn around and spend $1.2 billion of that money buying back its own stock. That company is Dropbox. And here's the detail that makes this genuinely strange. At the exact moment it took on that debt, its growth had slowed to a crawl. It had already gone through multiple rounds of layoffs, and its workforce had shrunk by nearly a third from its peak. This wasn't a thriving company throwing off cash. This was a company whose core business was, by most normal measures, stalling out. So why would anyone go into debt to shrink their own company? There's actually a name for this move in corporate finance. It's called a harvest strategy. And once you understand how it works, you'll start noticing it everywhere in tech, in retail, in industries you'd never expect. Today, we're breaking down exactly what a harvest strategy is, why Dropbox chose to run one, and whether this is one of the smartest capital allocation moves in modern tech, or a quiet admission that a company has stopped trying to grow at all. Let's get into it. Let's define the term properly, because it's one of those pieces of corporate finance jargon that sounds more complicated than it actually is. A harvest strategy is what happens when a company essentially stops trying to grow its market and instead pivots to extracting as much cash as possible out of the business it already has. Instead of pouring profits, or in Dropbox's case, borrowed money into research and development, new products, sales teams, or acquisitions meant to expand the company redirects that capital straight back to shareholders, primarily through dividends and share buybacks. Think of it like the difference between planting new crops and harvesting the field you've already grown. A growth company is still planning. Harvest company has decided the field is about as big as it's going to get, and the smartest thing left to do is bring in what's there as efficiently as possible. This isn't automatically a bad strategy. In fact, in certain mature industries, tobacco companies, some legacy telecoms, aging retail chains, running a disciplined harvest strategy can be one of the most rational moves available, precisely because pouring more money into growth in a market that's already saturated would likely just get wasted. The controversy starts when a company that still presents itself publicly as a growth story quietly starts behaving like a harvest one instead. Let's get specific, because the scale of what Dropbox did is genuinely striking once you see the full picture. In December 2024, Dropbox entered into a credit agreement for up to $2 billion in secured term loans arranged primarily through Blackstone Credit and Insurance, drawing an initial $1 billion with access to a second billion later. On that same day, the company announced a new $1.2 billion share repurchase program. CEO Drew Houston framed it publicly as a commitment to returning capital to shareholders while continuing to invest in new products like Dropbox Dash. But look at what actually happened over the following year. In fiscal 2025, Dropbox repurchased 60.4 million shares for $1.7 billion, meaning the company spent well beyond that original announcement, buying back roughly a sixth of its entire outstanding share count in a single year. Meanwhile, headcount fell from a 2022 peak of 3,118 employees down to just 2,113 by the end of 2025 after 3 separate rounds of layoffs. Put simply, between fiscal 2024 and fiscal 2025, nearly every metric describing the size and growth of the actual business shrank, while nearly every metric describing what shareholders were getting back improved. Fewer employees, fewer new customers, flat to declining reported revenue, and a dramatically smaller share count, engineered specifically to make each remaining share worth more. And this wasn't a one-time announcement that quietly fizzled out either. By the third quarter of 2025, Dropbox had already completed over $1 billion of that specific $1.2 billion authorization, buying back roughly 13.5% of the shares covered under that single program in just a few quarters. This was an active, sustained, aggressive campaign, not a symbolic gesture for a press release. Here's the part that trips people up. If a company's going to buy back stock, why borrow billions to do it instead of just using cash sitting on the balance sheet? Dropbox is, in fact, a genuinely strong cash-generating business. The company guided toward free cash flow at or above $950 million for 2025. So the debt wasn't a desperate move to stay afloat. It was closer to a financial engineering decision, and it comes down to two things: interest rates and share price. By borrowing to fund the buyback rather than draining existing cash reserves, Dropbox could execute a much larger repurchase much faster than its organic cash flow alone would have allowed. And because interest on corporate debt is tax deductible, the effective cost of that borrowed money is lower than it appears on paper. If management genuinely believed the stock was undervalued, trading for less than what the underlying business was actually worth, then borrowing at a relatively modest interest rate to aggressively retire shares below their true value is mathematically a way of creating value for the shareholders who stick around. Fewer shares outstanding means each remaining share represents a larger slice of the company's future profits, even if those profits aren't growing. This is the genius case. Buy low, reduce the share count aggressively while the stock is cheap, and let per share metrics like earnings and free cash flow climb even if total revenue stays roughly flat. Now here's the counter argument, and it's not hard to make. When a company that used to define an entire product category, cloud file storage, starts borrowing billions specifically to shrink its own share count rather than invest in new growth, that can also be read as a quiet signal that management has run out of convincing ideas for how to grow the business further. Dropbox competes directly against Google Drive, Microsoft OneDrive, and a dozen other free or bundled alternatives baked directly into products people already use. In that environment, meaningfully growing a paid subscriber base gets harder every year, not easier. There's also a less charitable reading of who actually benefits from this kind of move in the short term. Aggressive buybacks mechanically boost earnings per share and can support the stock price, and executive compensation at many public companies, including through stock-based incentives, is directly tied to exactly those metrics. Skeptic would point out that a harvest strategy can end up serving management's compensation targets and existing shareholders' short-term returns, even while doing very little to secure the company's competitive position 5 or 10 years down the road. Here's where the real story gets more interesting than a simple genius or desperation headline suggests. Dropbox's fiscal 2025 revenue technically declined by about 1.1%, but buried in that number is a detail that matters. The company had acquired a business form service called FormSwift for roughly $95 million back in 2022, then decided to wind down investment in it starting in 2025, with full shutdown planned by the end of 2026. Strip FormSwift out of the numbers entirely, and Dropbox's core file storage business actually grew by about 0.2% in fiscal 2025, and by 2% in the first quarter of 2026 alone. That reframes the whole story. This isn't necessarily a company in free fall borrowing money to mass total collapse. It's closer to a mature, essentially flat core business deliberately shedding a side project that didn't pan out, while its leadership makes a calculated bet that returning capital to shareholders is a better use of money than chasing growth in a market that's become brutally saturated. Whether you call that genius or desperation depends almost entirely on what you believe Dropbox's realistic growth ceiling actually is, and reasonable analysts genuinely disagree on that point. Here's the thought I want to leave you with. A harvest strategy isn't inherently a red flag, and it isn't inherently a stroke of genius. It's a mirror. It reflects what a company's own management actually believes about its future, whether they say so publicly or not. When a business quietly stops planting new fields and starts harvesting the one it has, that's usually the clearest, most honest signal you'll ever get about how much growth its leadership genuinely thinks is left to find. Dropbox didn't need a press release to tell shareholders what it believed about its own future. It told them with $2 billion borrowed dollars and exactly where that money went. If breakdowns like this are your thing, this is exactly what we do every week here on Dumb Economics, pulling apart the hidden math behind the world's biggest financial decisions. Hit subscribe so you don't miss the next one. See you there.